everyone. When we try to identify investment opportunities in stock market, one of the key steps is to identify the theme or sector that has a strong tailwind. Because if the sector or theme would do well, the companies that are leader in the space would eventually do well. And one such theme where I see immense growth potential is sustainability. We humans have made massive progress in last few decades, but it has come at the cost of depletion of natural resources and environmental degradation. And one of the biggest side effects is climate change. Hence, there is a strong need to create a circular economy where rather than dumping the waste, we recycle and reuse the products in a sustainable manner. On one side, the government is creating policies and regulation around recycling. On another side, corporates are taking right steps towards sustainable development and complying with ESG norms. On top of this, recycling industry in India is highly unorganized. All these factors have created a massive tailwind for organized players in recycling segment. The good part is, all leading players in recycling space are still small cap companies with immense growth potential to grow. Now, I have already done a detailed video on recycling sector stock, but it's also very important to closely track the company's performance along with having a good understanding of key risk for the sector. That's where in today's video, I want to touch base on the latest update on 4 companies that are leader in their niche. First is Gravita India, that is leading metal recycling space. Second is Vartek Vabag, that is leading water recycling. Third is Ganesha Ecosphere, that is leading plastic recycling. And fourth is Antony Waste, that is leading waste recycling. Alright, let's get started. Before we proceed further, we all know that the world is facing massive geopolitical uncertainty with trade war. Globally, things are looking quite uncertain. But one thing is clear. People who are combining technology and AI with finance are the new wealth builders. So why don't you dedicate just one weekend to learning something game changer that could transition your career? Well, here is your opportunity. I'm excited to invite you to a completely free 2-day AI training program which is valued at 10,000 thanks to a partner for the video Outskill. This is not just any training. It's the world's first AI-focused education platform backed by top AI investors and pioneers. The program spans 16 hours of live training across Saturday and Sunday from 11 a.m. to 7 p.m. Link is in the description. Here you will master more than 20 AI tools to add to your toolkit, prompt engineering for fantastic results, data analysis without the need for coding, creating professional presentation using AI and Excel, building tools and application with AI, no coding required. AI-generated images and videos, developing powerful AI agents, and automating tasks for maximum efficiency. And that's just the surface. This program is for everyone, whether you are in tech, sales, marketing, HR, operation, or even running your own business. Professionals from over 120 countries have already joined and loved it. There are limited spots, so don't miss out. Click the link in the description to book your spot now. And remember, there's an introduction call this Friday at 7 p.m. So get ready to level up your career. So let's begin with a company that turns your old batteries and scrap into valuable metal and has quietly become a global player from India. I'm talking about Gravita India, the leader in metal recycling. Gravita started its journey in early 90s as lead recycler. Later it's expanded into your recycling of aluminium, plastic, and recently started rubber recycling. Today, Gravita has a presence all over the world with plants close to procurement sources that helps in reducing the logistic cost and help in procuring material at cheaper price. If you look at volume-wise turnover, around 85% of company's volume is from lead recycling business. Aluminum and plastic business are still in nascent stages. Now, as far as growth drivers are concerned, the biggest growth driver for Gravita is government initiative and regulatory support. For instance, in 2021, government launched vehicle scrappage policy where commercial and passenger vehicles older than 15 and 20 years respectively will be scrapped if they fail the fitness test. This initiative would result in a massive amount of metal scrap and would need to be recycled. Then there are discussions where Indian government is planning to make it compulsory for automobile manufacturer to use 20% recycled materials out of the total weight of metal. Then data center, a fast-growing industry, requires 24/7 power that typically require acid-lead batteries. That would again require battery recycling. Now at the moment, this metal recycling industry is mainly an unorganized market that results in inefficiency in supply chain, poor quality control, and environmental hazard due to improper handling of scrap. That's why there's a massive opportunity for organized players like Gravita in metal recycling sector of India. Plus, company has also expanded into recycling of aluminum, plastic and rubber. If you look at the financials, Gravita India growth has been very impressive in last few years with 3 times growth in revenue in last 5 years and nearly 10 times growth in net profit. In the latest Q4 quarter, Gravita has posted 20% sales growth and 38% growth in net profits. If you look at company's share price, it has witnessed massive rally in the past. However, in last 1 year, its share price has corrected from peak of 2700 in September 24 to currently in the range of 17-1800. One of the key reasons was super expensive valuation with PE touching highs of around 70 during September 24 that is now at levels of around 42. Although valuations are still not cheap, but it seems Gravita will command a premium due to high EPS growth and strong tailwind for the future. Company also enjoys excellent ROE and ROCE, negligible debt along with a good cash conversion ability and currently commands a market cap of around 13,000 crore. Company's management has set a vision of 2029 with 25% volume growth in CAGR term, 35% plus profitability growth, more than 25% ROIC that is return on investment capital, 50% contribution from value-added product. This value-added segment include use of recycled material to make customized products like lead alloy, lead sheet, lead bricks, etc. that have higher margin. Its contribution in company's revenue has increased consistently and expected to reach 50% by FY28. That looks like everything is great about Gravita. So what are the key risks that you should be aware of? Well, one of the key risks is commodity price fluctuation. Try to understand this. Gravita buys scrap metals like lead, aluminum, etc., recycle it and sells refined and value-added metal. Please note that these metals are global commodities. Their prices are set by global supply demand and they fluctuate daily based on your economic cycles, interest rate, energy prices and geopolitical tension. Although Gravita manages this commodity price volatility using inventory hedging and operational strategies. For example, they don't stockpile scrap unnecessarily. Instead, procurement is often linked to expected dispatch schedule or confirmed contract. For large institutional buyers like battery OEMs, exporters, Gravita may lock in the selling price first and then source scrap accordingly. Then instead of just selling refined lead or aluminum, Gravita is also selling value-added alloys, plastic granules and customized product that often commands stable pricing and higher margin. And that provides cushion when base metal prices fluctuate. Having said this, there is still a risk with metal price fluctuation that needs to be tracked. Now let's move on to something even more critical, that is water. Within water recycling, I am closely tracking Vatek Vabag. Again, I have discussed water recycling in detail. Vatek Vabag offers solutions for drinking water treatment, industrial water and wastewater treatment, desalination of seawater, slush treatment, recycling and so on. Please note that Vatek follows asset-light strategy. That means instead of buying land, owning machine or doing civil construction, they focus on what they do best. That is designing water tech system, managing turnkey projects and operating those plants over the long term. Everything else is outsourced. This lets Vatek stay lean, scalable and focused on margins without locking up huge capital. Now this slide gives a good idea about company's business breakup. Out of FY25 closing backlog, 57% is from EPC work, that is engineering, procurement and construction, and 43% is from operation and maintenance. 80% work is from municipality and 20% from industrial sector. Within geography, 62% order are from India and remaining 38% are from rest of the world. So a good chunk of company's business comes from global market. As far as growth drivers are concerned, still millions of people in rural part of our country don't have access to clean water. Plus, many cities in India are already facing the groundwater shortage. Now, there are nearly 1,000 sewage treatment plants in India, but most of them are inefficiently run by municipality that lacks quality standard. In fact, data suggests that nearly 70% of wastewater generated goes directly into rivers and lakes. That's where Indian government has launched multiple projects with the goal to provide clean drinking water to every person of the country. So first biggest opportunity is the treatment of wastewater by installing sewage treatment plants. Then second opportunity is water desalination segment. So desalination is basically the process in which salt is removed from seawater. Then third immediate big opportunity is in zero liquid discharge segment. It is basically to treat the industrial wastewater. Apart from these immediate opportunities, there are two mega themes in India that has created opportunity for water recycling companies. First is semiconductor industry that requires ultra pure water to wash the chips. That's where companies specialized in water processing could come into picture. And second is green hydrogen, which is considered fuel of the future. And that's where you would need water to produce hydrogen from it. If you look at Vavak financials, top line is sort of struggled in the past, although there's a decent 15% growth in trailing 12 month. But company has managed to expand its margin that has resulted in 29% CAGR growth in net profit in last 5 years. Other KPIs like ROCE is very good at 20%, ROE is slightly low. Debt to equity is also negligible, cash conversion rate is also excellent. Company's Q4 results are also excellent with 24% growth in sales and 37% year-on-year growth in net profit. Going forward, for medium term, company has an order book of 3 times its revenue and expect 15 to 20% CAGR growth in revenues with 13 to 15% EBITDA. So there is still some scope for margin expansion from current levels of 13%. ROCE target is more than 20%, ROE target is more than 15%. Considering all these factors at current levels of PE of around 31-32, Vatak Vabak looks decent with a market cap of around 9,400 crore. Please note that Vabak predominantly being an water recycling EPC company with higher cash conversion cycle and higher receivable would not command a very high PE ratio. So current valuation do not give scope for valuation re-rating. But considering 15 to 20% revenue growth with scope for margin expansion and improvement in cash conversion along with receivables, there's still scope for upside over the next 1 year based on performance. Now from water, let's move on to a problem that is literally piling up around us. That's plastic waste. Within plastic recycling, the leading player is Ganesha Ecosphere. Again, I've discussed this company in detail in the past. To summarize the business, broadly, it can be divided into two parts. First is the legacy business that converts PET bottle into recycled polyester staple fiber, that is RPSF, as well as your dyed yarn and spun yarn. It primarily caters to textile sector, but this is a cyclical business with pressure on margins due to textile demand swing and cheap imports. As of FY25, this legacy business contributed approximately 60% of company's revenue. Now Ganesha Ecosphere has expanded into new vertical, which is FMCG and packaging segment, where it recycles plastic bottles for brands like Coca-Cola and Varun Beverage. This segment is less cyclical and has better margin. Now here is the biggest tailwind for Ganesha Ecosphere. India has made it mandatory that by 2025, at least 30% of the PET used in packaging must be recycled. That number can go up to 60% by 2029. So imagine this. Every Coca-Cola, Bisleri or Nestle bottle will have to use recycled plastic or face penalties. And Ganesha Ecosphere is one of the few players in India that can supply FMCG grade, food safe recycled PET chips. This is no longer a trend, it's a regulation. And that's where companies' new business could see multi-year structural growth. Now if you look at the financials, Ganesha Ecosphere revenue zoomed 31% in FY25 and net profit jumped exponentially by 159%. However, Q4 performance was on weaker side with 13% revenue growth and 10% net profit growth. The key reason is the legacy business has been facing challenges due to higher input prices and compressed demand from textile segment. Management stated that the outlook for standalone business is not good for next 1 or 2 or 3 quarters, describing the period as painful for this industry. Overall for FY26, management has guided for 16 to 20% growth in revenue. But Ganesha Ecosphere can face margin pressure in FY26. This is important to understand and also one of the key risks for the company. Basically, Ganesha Ecosphere recycled PSF prices are benchmarked against the prices of virgin PSF, which in turn is linked to the prices of derivative of crude oil. In short, if crude oil prices increases, it results in margin expansion for Ganesha Ecosphere. That's what happened in FY25. Margin expanded from 12% to 14% because crude oil price jumped in FY25. However, there's a sharp fall in crude oil price in last few months and that can put pressure on Ganesha Ecosphere margin and net profits in FY26. That is one of the reasons why its share price is underperforming for some time. That said, company plans to increase the Warangal plant's RPT granule capacity from current 42,000 metric ton per annum to 64,500 metric ton per annum by December 25. So FY27 should see good growth mainly from its RPT business, which is food grade recycled PET chips. In fact, this expansion is part of broader initiative to enhance its total RPT capacity to 1.32 lakh metric ton per annum, including a greenfield project in Odisha. So while FY26 may remain a bit muted for Ganesha Ecosphere, long-term prospects are still intact with strong tailwind from FMCG and packaging segment due to government regulation of up to 60% recycled plastic by FY29. And today Ganesha Ecosphere is just 3,500 crore company trading at a PE of around 35-36. Now let's talk about something we all generate every single day: solid waste. Final Stock is a leader in waste recycling. It's Antony Waste Recycling. It is India's largest listed municipal solid waste management firm. This slide gives a brilliant picture of company's nature of work that span across the value chain of waste management, right from door-to-door collection of waste, transportation to processing facilities, segregation of organic waste from recyclable and inert materials, then construction and management of landfills, where it manages largest bioreactor landfill, then recycling of waste, then composting, and even it has forayed into waste to energy, where it handles 1,000 ton per day waste at PCMC facility, generating around 14 megawatt power. If you look at the revenue breakup, collection and transportation, that is the first two steps, contributed around 61% in company's revenue as of FY25. Currently, there are 17 ongoing contracts with average duration of 7.7 years. Then waste processing, that include sorting, segregation and recycling, contributes 27% in revenue. Remaining 12% comes from mechanical and manual sweeping of street, sale of goods and revenue from sale of scrap. As far as growth drivers are concerned, rapid urbanization in India is generating nearly 1.5 lakh tons of solid waste per day. And government has two flagship programs, Swachh Bharat and Amrut Mission, where it is pushing for 100% waste collection, scientific composting and waste to energy production. That creates a lot of opportunity for Antony Waste Handling that has more than 20 years of experience with presence across your solid waste management value chain, from collection to recycling to power generation. If you look at company's financials, its revenue growth has been steady at around 16% CAGR rate in last 5 years. However, company's margins are a bit volatile and hence net profits are also volatile. In last 5 years, net profits have grown at 15% rate, but in FY25, net profit has remained flat. After the latest Q4 result, I went through company's con call and management has guided for 20 to 25% CAGR growth on operating cash flow over a 3 to 5 year period. But they also clarified that this is not a year-on-year growth target, as consistent year-on-year growth of 15 to 20% is difficult to maintain in their business. So it's important to keep a note of this. Don't expect linear growth. Currently, company's profitability metric like ROE and ROC are on lower side. Debt to equity ratio is reasonable. CFO to EBITDA, that represent cash conversion, is excellent. It's a very small company with market cap below 2,000 crore with a PE of around 26-27. Valuation wise, again it looks okayish. Neither too high nor too cheap. Considering the nature of its business, where the key risks include dependence on municipal corporation for projects, then volatile business growth and capex heavy business, market would not like to give a high PE multiple to Antony Waste. But considering the potential in waste management and strong tailwind for recycling of waste, Antony Waste Handling can be a strong beneficiary over the long term. So there you have it. 4 niche leaders riding the sustainability and recycling wave in India. From Gravita India's leadership in metal recycling, to Vatek Vabhag's critical role in water treatment, to Ganesha Ecosphere FMCG grade plastic recycling, and Antony Waste end-to-end municipal solid waste management. Each of these companies is solving a real long-term problem in India. Yes, they are all small or mid-cap names with risk like commodity cycle, margin pressure or government dependency. But they are also early mover in sectors with strong policy push, ESG tailwind and massive unorganized to organized market shift. If India truly want to grow sustainably, these are the kind of companies that will play a central role. As always, this video is for educational purpose and not a buy-sell call recommendation. If you found value, do like, share and subscribe and let me know in the comments which of these 4 companies you are tracking closely. Thanks for watching this video. I'll see you next video. Till then, take care.